Good to have you with us this morning. Our busy week of bank earnings continues with Canada's largest financial player reporting results this morning. Royal Bank topping street estimates in the latest quarter as stronger than expected returns in its capital markets and wealth management business countered an increase in loan loss provisions as well as higher expenses. Overall, RBC reporting earnings of $2.85 per share on an adjusted basis, topping the $2.80 estimate on Bay Street. On the loan provisioning front, Royal setting aside $813 million for possible bad loans, which is a bit more than analysts had been estimating. Now, recall yesterday, both Scotiabank and Bank of Montreal had set aside increasing amounts to protect against the downside if the economy weakens. Meanwhile, on the cost side, Royal has been working to rein in expenses with recent rounds of job cuts in both Canada and at its struggling City National Bank unit in the United States. We also mentioned in our newscast National Bank results. Profit in the latest quarter was higher thanks to revenue growth across its business, even as it joins other banks in raising loan loss provisions. For more on what's happening in the banking sector and a broader look at the markets, we're joined this hour by Ryan Bushell. He's president and portfolio manager at Newhaven Asset Management. Ryan, good to see you.
Thanks for having me on.
Any takeaways for you from the bank earnings so far?
The big thing everybody's looking at is the provision for credit losses. So right now, kind of more skewed towards commercial real estate, and the results are good enough, right? The banks are not expensive, so they're not trading with too much volatility around these results. But we're tiptoeing up to those mortgage renewals, that big bulge of mortgage renewals in Canada, which is set to sort of start late this year through 25 and into 2026. And I think that's really the big unknown. We'll have to see, I think a lot of people were thinking we'll see rates down 50, 100, 150 basis points by the time that bulge hits. That's looking increasingly unlikely, at least the way this year is going. I think people also thought, we might be in a deeper recession by the time that comes. That's also looking increasingly unlikely. So you've got some positive factors, some negative factors, and that's going to be important for the Canadian banks as we move forward.
So if you're a bank investor and you hear about all these big players setting aside money for potentially bad loans, there are chapters when we're not talking about parallel macro themes that impact everybody where you say, bank is worried about its loan portfolio. Is that a greater concern? In this case, how do you view that versus the idea of, well, it's a bank? Prudent planning in the face of uncertainty is to be ready for a worst case scenario.
Yeah, that's right. It's interesting to go back to 2020, right? So 2020, huge credit provisions taken because nobody knew what was happening at that point in time. People were unemployed overnight, Canadian homeowners were already heavily indebted at that point, and those provisions came not to pass, right? And then they ended up releasing them in 2021, 2022, which led to some big tailwinds for earnings and tailwinds for results. So this is all kind of on paper until it starts to actually hit with those mortgage renewals. And so, the question will be, are they taking enough? And that was one interesting thing with BMO versus Bank of Nova Scotia this quarter. Last quarter, Nova Scotia took more credit provisions. Stock got hit. BMO did not take as many provisions. Stock performed. This quarter, BMO took more credit provisions than Scotia did on a relative basis. Stock got hit. Scotia took less. Stock performed. So, to me, this is all kind of near-term jockeying around the bigger theme, which we're all anticipating, and it's just not going to play out until it does, and that's, roughly a year from now.
And how much, as an investor, would you look at those levers that all banks can respectively pull versus what's actually happening with the banks themselves? They become so generic when we just sort of talk about them at this high macro level, but they're full of people and they've all got different strategies, and we saw some of that factor into the latest quarterly results.
Yeah, and that's kind of how we're looking at the sector. So we're underweight. We've been underweight for some time, and it's not because we don't like the banking sector. We still own 4 of the 5, the big 5. We still have about a 15% position in banks, but we just don't think their underlying businesses are as exciting in the next 10 years as they were kind of in the last 20. There's less consolidation opportunity. It's really a cost-cutting technology, grind it out. We don't think the mortgage market is as attractive in the next 10 years as it was in the last 20, in terms of the volume of lending. So we think it's status quo. Multiples are low, yields are good, dividends likely to be maintained and increased slowly. So it's a part of our portfolio, but we don't think it's on a big picture basis. We need something to be a catalyst to push it more.
After the break, we're going to talk a little bit more about energy and infrastructure, which feeds into an area you spend a lot of time focusing on, but the keyword being yield. I mean, you are oftentimes looking for good income returners for your investors. The banks themselves always have those dividends and dividend yields as a calling card, but when you look at them versus other opportunities, how do they match up?
Yeah, so that's exactly it. We just don't think the growth, it's a big part of our portfolio. It's still one of the biggest parts of our portfolio. It's just not 25% of our portfolio, which is where a lot of Canadian investors were, 5 to 10 years ago, right? So that's
because you maybe don't see the potential for income growth or higher dividends versus maybe some other players out there?
Yeah, just not as much. Yeah, and not as much, a little bit more volatility as well, right? We're seeing, again, we've got a big leverage problem in this country, and it's going to play out through the banks in one way or another. And again, it may take a long time, it may take a short time, but we just don't want to be overly exposed there if and when that goes the wrong way.
Okay,